Hi, Mike Almali, recovering CPA, back with this next lesson in financial accounting, a mercifully brief introduction. Many businesses find it necessary at some point to borrow funds. Lenders need to assess the creditworthiness of these borrowers. Two determinants of creditworthiness are the existence and extent of collateral and the liquidity of the business. The balance sheet can be useful in assessing both these factors. Collateral are those assets that are pledged by a lender to secure a loan. Even though assets, particularly fixed assets, are not carried at current fair market values on the balance sheet, the lender can determine the kind of assets the business owns and the extent of debt to other lenders. It's usually not difficult for lenders to reach reasonable estimates of the current liquidating values of most business assets, so the absence on the balance sheet usually is not a major problem. Liquidity is another useful determinant of creditworthiness. Liquidity refers to the availability of cash to the business. Obviously, lenders are concerned whether borrowers will have sufficient cash to repay loans. Liquidity is mainly a function of profitability. Ordinarily, the more profitable the business, the more cash available. However, liquidity is not simply a function of profitability, and firms of comparable profitability do not necessarily have comparable liquidity. Other factors affecting liquidity are the rates at which accounts receivable and inventory are converted to cash. A business that collects its accounts receivable in an average of 20 days generally has more cash on hand than a business that requires 45 days. Similarly, a business that turns over its inventory 15 times a year has more cash on hand than a company that turns its inventory over only 11 times a year. Another indication of relative liquidity is the ratio of current assets to current liabilities. All other things being equal, a business that has a higher ratio of current assets to current liabilities is more liquid than a company with a lower ratio. A company's balance sheet may be used by a creditor to measure the liquidity through the use of ratio analysis. Two of the most widely used liquidity ratios are the current ratio and the quick ratio. The current ratio equals the current assets over the current liabilities. Looking back at joint venture's balance sheet, notice that it had $20,413 of current assets and $9,552 of current liability. This yields a current ratio of 2.13. Now, because certain current assets such as inventory and prepaids are not immediately convertible to cash, the quick ratio is often used as an alternative measure of liquidity. Quick assets are cash, marketable securities, and receivables. Joint venture's quick assets are $19,138, yielding a quick ratio of 2. Generally, creditors want these ratios to at least equal 1. If the ratios fall below 1, the firm's current liabilities exceeds its current or quick assets, which is not good if you're a creditor. Now, another important set of liquidity ratios for a business with significant credit sales is the accounts receivable turnover and average collection period ratios. Credit sales are all non-cash sales. Average accounts receivable is the average of the beginning and end of period balances. The higher the turnover, the better the collection experience. Assuming that all $90,000 of joint venture's delivery revenue was credit sales and its average net accounts receivable was $15,000, the accounts receivable turnover would be 6. An even more useful measure of the effectiveness of a business collections is the average collection period. This is a more useful ratio because it computes the average number of days it takes to collect accounts receivable. If the business extends credit for 30 days, its average collection period should not be much greater than 30. Since joint venture's accounts receivable turnover was 6, its average collection period would be about 60 days. This collection period would be considered too long if the firm's policy is to demand payment in 30 days. For businesses that sell inventory, a very important liquidity measure is inventory turnover. Average inventory is the average of the beginning and ending inventory. What does inventory turnover measure? It literally measures how quickly inventory sells. The higher the ratio, the more quickly the inventory moves. Quick turnover is desirable because it means that goods are more quickly turned into cash. A quick turnover of inventory may be an indication that a firm is selling the right products. On the other hand, too quick a turnover may mean that a company is pricing its products too low. Here's an example. Janus had $50,000 of cost of goods sold on an average inventory of $2,500 during the recent year. This means that her inventory turn was over 20, 50,000 divided by 2,500. This may seem like a reasonable turnover for a product, but is it? It would help to have information about other firms operating in the same industry. For most types of firms, such information is available in widely used databases. Now we turn to another set of ratios, the leverage ratios. Creditors are also interested in a debtor's firm's leverage. Leverage is the degree to which a business finances itself with debt instead of equity. Increasing reliance on debt increases the rate of return on equity in a profitable business, but also increases the risk of going under due to too much debt. Here's an example of how leverage works. Hansel and Gretel Grimm are contemplating opening a guided tour company called Babes in the Woods. They project they will need to raise $10,000 to start operations. They have a choice of borrowing half the needed funds or using only their own funds. They believe the business will generate about $1,000 a year in net profit. If they do no borrowing, their equity will be $10,000 and the expected return on equity, net income divided by equity, will be 10%, 1,000 divided by 10,000. On the other hand, if they borrow $5,000 and use just $5,000 of their own funds, the expected return will be 20%, 1,000 divided by 5,000. Now, although leverage is often regarded favorably by borrowers, creditors view it negatively. A high degree of investment by owners provides a greater incentive for the owners to succeed. If the owners have very little of their own money invested, it is psychologically easier for owners to walk away from a struggling business. Creditors thus want to lend to firms in which the owners have a large investment. Now, a common measure of leverage is the debt-to-equity ratio. In small to medium-sized businesses, it is not uncommon to have ratios of between 3 and 4. This means for every dollar the owner contributes, there is between $3 and $4 of debt. Joint ventures' total debt was $16,177. His total equity was $15,484, yielding a debt-to-equity ratio of a little over 1. So click here for the next lesson.